A bear market can be a scary time for investors. Inflation and supply issues have struck all around the world, and people are starting to feel the pinch. But that doesn't mean there aren't opportunities available. In fact, for some people, a bear market is where they do their best business. So how do they do it? Hey, I'm Kylie and welcome to the channel. Today I'll be talking about how traders can actually make a profit during a bear market. Just bear in mind that many of these strategies require a high risk tolerance. As I'm sure you're all across this does not constitute as financial advice. If in doubt, consult an expert before making any significant financial decisions. Always. Okay, enough with the disclaimers. Let's jump in. So there's actually a pretty interesting story behind the term bear market. In the 1700s, there was a well-known proverb warning against selling the bearskin before one's caught the bear, or something like that. Anyway, the idea here is that hundreds of years ago, traders would sell bearskin before they actually had the product. So bearskin sellers were speculating that hide prices were about to drop and aimed to lock in their current value. Since those times, the term bear market has evolved to mean any market that's experienced a 20% drop or more. So what does this all mean for today's bear market? Well, first of all, just because we're in a bear market or we have been in a bear market, it doesn't mean you need to panic. As with any other market condition, smart traders will look to maximize their returns by using different strategies for the current conditions. Okay, so let's look at 5 ways that traders can profit during a bear market. But before I go on, this video wouldn't be possible without our terrific sponsor Think Markets, and they've even written a helpful guide on bear market trade strategies, so be sure to check it out. There's a link in the description below. Number 1, shorting. One of the main opportunities that a bear market presents is to take advantage of falling prices by short selling or shorting. Instead of the usual buy and hold strategy, shorting involves speculating on the basis that prices will fall. The basic idea of shorting is to borrow stocks, sell them on, and then repurchase them for a lower price. And if this strategy is successful, it means that traders can profit from a falling market or a falling asset. It's definitely a higher risk strategy, but by that same token, it offers potential for high rewards. That being said, opinions about shorting does vary. Some critics see it as effectively betting against the market or betting against an individual company. But for others, shorting is just one more way to keep the market in check. It's a pretty complicated topic, so I spoke to an expert to get a better idea of some of the risks and rewards of shorting.
The risk is where the price goes up. That's the only problem with short selling. And we don't know how high the price could go. Now, if you flip that on its head and look at your typical buy and hold approach, our risk, of course, is that the price goes down, and we know prices can go down very quickly at times as well. So at the end of the day, the risks all come down to being able to predict with some sort of accuracy where that price is going to go. So as an investor, if you've got a view on a particular company's earnings, and share prices will move based upon those earnings. So if they're deteriorating, that's when you're starting to look at your short selling options. And if the earnings are improving, you're starting to look at your buy and hold options. Just about getting the direction right.
The second trick is hedging. The easiest way to describe hedging is speculating both ways, often to soften the potential blow to a portfolio. Well, there's a bit more to it than that, but the principle holds true. Hedging is a strategy that's designed to help offset your exposure by taking a position in areas that might be counter to or even outside your usual portfolio. For example, some traders might move some of their assets into gold or into government bonds to hedge against market downswings. That's because when the market goes down, bonds and gold tend to go up sometimes. Not all the time, but sometimes. Or if they have a portfolio of, say, energy stocks, they could hold an opposing short position against those same stocks. Carl explains it better.
One of the best applications for short selling is to protect your normal buy and hold portfolio. So I have many investors who come to me and often will say, Carl, I'm a little bit concerned about the market. I'm a bit concerned about the way interest rates are going, cost of living pressures and what impact this might have on my portfolio, but they don't want to sell that portfolio. They're concerned that there may be capital gains tax implications. They're concerned that if they do sell, the market continues to go up. So one of the strategies you can use with short selling is, it sounds a bit odd, but to actually short sell the stocks in your portfolio. And this is a concept called hedging. Basically, what we're trying to do is to offset any potential losses if the market goes down in that for our portfolio with profits from the short sales of stocks in that portfolio. So remember, short selling is about selling an asset and looking to buy it back at a cheaper price and therefore crystallizing a profit. If the price of the shares in our portfolio go down, the profit we make on those short sales will compensate us for any losses in that portfolio.
Number 3 is probably one you've heard before, but it's still really important, so I'm going to repeat it again. Diversification. When there's a bear market, not all sectors will do poorly. Some sectors will actually do better when there's a bear market. This is why a diverse portfolio can be a great way for traders to spread their exposure more evenly. Diversification can be as simple as investing in a stock portfolio that is across multiple sectors, or it could be across different asset classes entirely.
We're seeing a great deal of interest in energy companies, particularly those with exposure to natural gas production, as I said, and also thermal coal production, because if you can't get the natural gas, the next logical place is to go to thermal coal. So we've seen many of our clients invest in the likes of the Whitehaven coals that are out there, Terracom, New Hope Corporation, and Yancoal, all very popular with our clients. Woodside, in terms of the natural gas angle there. And I do think that's going to be a key area of the market to continue to watch. Otherwise, of course, lithium is very popular, and that's just sort of another angle on this energy security, finding renewable alternatives to that as well.
Number 4 is identifying trends. This includes both technical and fundamental analysis and, of course, market forces. Essentially, you're looking at what factors are influencing the price of an asset. It could be inflation, or it could be interest rates, government regulation, high energy prices, war, natural disasters, shortages, or just a shift in supply and demand. Traders are always looking for wider industry and market trends.
I think we've got to get over a hurdle first, and that is the Northern Hemisphere winter. And I do feel that we are going to have, at least at one time this Northern Hemisphere winter, a massive crunch in those energy markets where there simply isn't enough supply to satisfy that demand. And we're going to see some pretty large increases in a number of those energy commodities. So there's potentially opportunity there, as I said before, to trade some of our energy sector stocks or to go directly to those energy commodities. And then I think things will settle down after that. And I think if we can get that energy cost situation under control, it's going to help us on that inflation front. It's going to help us on that cost of living front. And hopefully then we get to the other side of the valley where some of our central bankers can start to feel that inflation is coming under control.
Then there's fundamental analysis. Now, we could do a whole video on fundamental analysis. In fact, we have done so. You can check it out in the link below. But the most important takeaway is the importance of researching a sector or a company. For instance, looking at historic performance, actual profit, earnings, and more to gauge the potential future growth. And this applies even during a bear market. After all, just because a company's share price has fallen, say, 80%, doesn't mean the company is necessarily worth 80% less. The next consideration is technical analysis. Technical analysis is basically another name for charting. Being able to read certain types of charts and indicators, even at a basic level, is a really important skill for traders to learn.
You know, I love my charts. Definitely a charts first and probably fundamentals second kind of person. I do think that the charts and the underlying trends summarise many of those fundamental factors. Certainly when you look at a chart of natural gas, for example, it's pretty clear that there's a great deal more demand at the moment than there is supply, and therefore that can facilitate higher prices. So if you can find a way through your charting, through your charting package or your technical analysis to identify those underlying trends, I think you're going to be way ahead. I'll give viewers a couple of tips here. I think moving averages are a really underrated way of identifying those underlying trends. I like to use a couple of them. So I like to use a short-term moving average. In this case, I think the 50-period moving average is really sensible, and a longer-term moving average. So for example, a 200-period moving average. And you can pretty much bet when those two trends, those short-term and long-term trends, are heading in the same direction, it's usually a pretty safe time to enact a trade. So if they're both heading up, you've got an uptrend, you can be looking for your buy and hold strategies. But if they're heading down, that's when you could be looking to implement some of your short trades.
Last but not least, it's important to take a break. Bear markets can be pretty emotionally draining, and trading can be emotional even at the best of times. This is a key reason why traders should never trade more than they're willing to lose. So maintain a healthy psychology by learning when not to trade, when it might be best to sit out and go to cash. or keep some dry powder on the side, ready to take advantage of potentially lower prices still to come. Well, those are 5 ways that traders can make a profit and keep their cool during a bear market.
It is important when you have that volatility, number one, to have a strategy. And I think if you have a strategy or a set of rules determining how you interact with the market, it's a great fallback. So look, I'm really emotional right now, but what do my rules say? Well, my rules say stay out. And that might be a really good thing to do. And I do think if you find you're getting to that point where you are burnt out, it is a good time to take a step away from the market. Look, you can't lose when you've got all your money out of the market, and sort of reassess and reflect upon how well you've been following those trading rules. We often find that the markets are most volatile, we're the most emotional, and we know when we are the most emotional, we tend to make the worst decisions about our portfolio. So we need an emotional circuit breaker in there somewhere.
Well, we hope you've enjoyed learning about some of the ways that traders can profit and keep their cool even during a bear market. After all, even though bear markets can be challenging, they're also a natural part of the economic cycle. And they don't usually last that long. In fact, the average downward cycle lasts less than a year. By comparison, the average bull market goes on a 3-year run. Well, that's it from me. If you like this video, please go ahead and hit the like and subscribe button. And I've also left some links in the description below if you'd like to check out some of the other videos and other guides that we've done on the subject. Thanks guys, happy investing.